Hello, everyone. Thank you for attending another episode of Real Estate Investing. And my name is SeeWing Yee from the Yee Real Estate Network. And my special guest is no other than Maureen Mccann from Spartan Invest. How are you, Maureen?
I couldn't be any better. Today is a beautiful day.
Absolutely. And I know exactly what you're talking about in your neck of the woods, the most desirable place to live on earth, in my humble opinion. Anyway, let's go forward. I know. Thank you for logging in, presenting. I know you have a very busy day to running your real estate consulting business and handling many out-of-state investors. Spartan Invest does turnkey properties for out-of-state real estate investors from all over the country and even the world. And you guys have been doing it very successfully. And you guys are focused in the areas of Alabama, Tennessee, and northern Georgia. And today we can talk about some real data, some data on Birmingham, Alabama, and Tuscaloosa, Alabama. We can go over the Redfin weekly sales data. So it's sort of a quote unquote real time housing data. So we can talk about all the different metrics as to what's going on. So without further ado, let me share my screen. Then we know what we can talk about, right? So anytime as I go through all these kind of links, you just feel free to speak, Maureen. Interrupt me anytime you want. So all right, shall we get it started?
Let's get it started. Let's roll.
All right. So first, we can talk about Birmingham, Alabama. Then, when we get done with this 10 to 15 minute module, we can talk about Tuscaloosa, Alabama, and let's look at the data in many different metrics. So we're going to start off by using the Redfin. They provide this very good platform for consumers to evaluate the ongoing changing dynamics of real estate data all over the country. There are 400 MSA markets, metropolitan statistical areas, 400. So today we'll talk about two areas, Birmingham and Tuscaloosa. So we can start off by going over the 3-year trending, 3-year data with respect to median sales price in Birmingham, Alabama. So let's go over the 2019 data year to date in August. The median sales price at that time was $218,000. Then the right at the beginning of the pandemic, the Birmingham, Alabama housing market has increased 12% year over year from 2019 to 245,000, and then from 2020 to 2021, it increased another 9% appreciation from 2020 to 2021 to 266,000. And then from 2021, August until today, August 2022, it has increased another 12% to, I need my reading glass, to 294,000. So to recap, the 3 years appreciation rate on median price in Birmingham is from 218 to 294. So there's a good trending. So this market, right? So people have achieved pretty significant amount of wealth over the past 3 years. So yeah, so that's a good sign. And now I see why, Maureen, your company is continuing to promote Birmingham, Alabama. So any quick thoughts on this appreciation trend in the past 3 years?
Well, this is very reflective of how happy my investors are because they've been able to. I know we've been in business for almost 10 years, and so I've got investors that have held properties for 10 years. They just bought a year ago or 4 years ago, and they've seen some significant capital appreciation, which Redfin here has so eloquently displayed for our viewers. And when you're a turnkey operator, you're looking for emerging markets that are growing, that have a good, stable economy. They are very business friendly. It's a business friendly climate. And so, I wish I could say SeeWing back in, let's see, this goes back from 2019 to 2022 that when I started in 2013 going, oh yeah, this is exactly what's going to happen in the market. You don't know, right? But you definitely know that it's an emerging market. You can see the population growth, definitely trending through the job growth. And here is a really nice depiction of what the housing values have done in this particular area in Birmingham, Alabama. And so investors that got into the game, whether it's a year ago, 5 years ago, 10 years ago, they are experiencing the equity growth in their homes and doing cash out refinances, taking the money out to buy more.
And of course, yeah, you get some good cash flow as well. So good rental market and the whole 9 yards. So very, very good. All right, so let's go over the new listings to see what's going on with new listings. All right, so go ahead and click the new listing, and as you can see, this past month, the new listings has increased to the tune of 434 houses coming to the market. So kind of a vertical big trend line. So that's a good sign. So new listing. Now let's look at the active listing in the overall Birmingham Metro. So 2022 active listing is approximately 3,576 houses actively listed in the multiple listing service. I know you guys promote off-market turnkey investment properties, so you have a different kind of niche as opposed to other owner-occupied buyers, primary home buyers, for example. They have to rely on the multiple listing service, the data that we are sharing. So it's sort of a not really apple-to-apple comparison, but still, is a good data to compare. So we're talking primary home buyers with the multiple listing service versus your turnkey out-of-state listed buyers that go through your inventory, which is off-market, not part of the multiple listing service, which is good. So it's so anyway, so active listing is so like 8% year over year less than the previous year, which is 2021. So and over the past few years, it's kind of similar. Nothing out of the ordinary in terms of active listing. And now let's look at the new listing median price. Right now has been trending a little bit downward from the peak, which is April this year. The median listing price was 293. However, now August, a few months later, he's at 277, which is 7% higher year over year from last year. I suspect the reason why the median list price has gone downward is because of the higher interest rate, and people can only can afford a little bit less of a property due to the higher interest rate, therefore higher mortgage payment. So not to say houses are all going down in value. No, that's not the case. So I'm sure Maureen, you'll agree, right?
Yeah, and I would say this is a really good. These are the graphs that you're showing. These are really good reflections of what's happening in the market, and it can be very confusing for either investors, even home buyers, or like they're saying, oh, there's depreciation. There's not depreciation. It's deceleration of appreciation, right? So we're still at a market. We're still at capital growth that is still significant. Yes, we're seeing more houses being listed, as you showed in the previous graph, but it's still not enough, specifically in our market, to meet the needs or the demand in our local market. So yes, we're seeing some softening, some deceleration so basically the prices aren't continuing to skyrocket, to go into infinity. It's not happening, and it's being cooled. The market is being cooled by the elevation of the interest rates. And like you said, before when we had, where a primary, you could get a primary for 2 or 3%, 30-year fixed, you could afford more house because that low interest rate filled in that big gap. You could go get a bigger house, a more expensive house, because the mortgage payment was so affordable at a 2 or 3%. As the interest rates have risen, I think it's 5.5 for primary homeowners. It closes the gap a little bit, and it just pushes people that it's harder to make that monthly payment now because the price of the house has risen, so is the interest rate, so it makes it more difficult for them to purchase. But it doesn't mean the purchasing is stopping. That's not the case, and it doesn't mean that we are in a depressionary state. Properties, instead of appreciating 19% from 12 months ago, they're forecasted to increase at 9%. So you're just seeing a deceleration, not a depreciation. That's the difference.
Yeah, exactly. I mean, the double-digit or triple-digit appreciation that we have seen over the past 2 years, it cannot be sustainable. It's not a healthy market. So perhaps it's a good time to balance out the market. So therefore, people have an opportunity to buy without multiple offer bidding and without bidding over the list price, those kind of things. So in a way, it's good. So yeah, Maureen, another things that people get confused is I'm gonna click on the name price drops. I know I don't want people to freak out, right? When people when the media, when the YouTube video and the mass media talk about price drop, housing crash, 80% value depreciation. No. People need to stop using the news media and the YouTube videos. It's all everybody, going for the clickbait in the YouTube videos and by, reporting all the doom and gloom negative headlines. But now, price drop in this category, I don't know. I don't like the way the words is being used. It's not really price drop. Okay, and we see this big trend, right? 2022, skyrocketed trend from as recent as back in May of May of this year, a few months ago, it was at this low. Now it has skyrocketed to August 2022, which is now percent of active listings with price drop 7%. It just means that when a seller a few months ago, maybe they did not get the memo. They list their price too high relative to the decreased demand based on the increased interest rate. And sellers are very overzealous. They want to price higher because their neighbor has sold their house with a tremendous over asking before the interest rate increase. So they price their homes initially way over the fair market value, and then once the house or not is not being sold, is sit on the market for 1 week, 2 weeks, 3 weeks, that they decided, hey, maybe I overlisted my price. Let's reduce our list price from $290K to $280 or $285, $5,000 or $10,000 reduction in list price. That's what this trend is all about. So sellers not getting the memo. It remains to be seen the next few months, perhaps toward the end of this year, whether the seller understand the market has reset and that they need to be realistic. They need to list their price in relationship with the market lower demand, and also so this trend line should not go vertical much longer. If it is, then something's wrong with the market. So we're seeing sort of a balancing out situation. So again, I don't want people to freak out that the market, the prices are dropping in Birmingham or anywhere else in the country, showing similar trend similar to this. So what are your quick thoughts on this?
Yeah, this is another good graphic here where this is the scenario, right? So in the frenzy, when everyone was selling their houses and it was people were having multiple offers within the hour of it being listed and then having a contract within an hour and a half, right? Okay, that's not the environment we're in right now. But here's what's going on. People that sell their house for, in this neighborhood, let's call it 290,000. They go, okay, well, if they just sold 2 months ago for 290, I'm just going to throw $10,000 on top of it or $15,000 on top of it just to see if I get it, right? And then when they don't get it, because now they listed at the time where the interest rates started to change, and they changed pretty rapidly, right? It's the fastest I've seen them change in my 13-year career in a very short time. So what happened to their neighbor 2 months ago is not their same situation. It's still a good situation because there's not enough inventory for the demand, but they have to come back to realistic, after realistic listing price. And so that's what we're seeing happening. So when you're seeing all these price drops, it's not because it's a desperate situation. It's they threw a number out there hoping to get more for their home than what their neighbor did just 2 or 3 months ago. And because the environment 2 to 3 months ago is different now from an interest rate perspective, people that are motivated for whatever reason, like I've got a neighbor, he's selling his house here in my street because he's building a custom home in Henderson, Nevada. And so he's priced his property right. The house next door to him sold for 3.75 million, but that was 6 months ago. He's got his listed for 3.3 million. So his is priced right. Now, could he have listed it for more than what his neighbor sold it for? He could have, but he had some good advice from the realtor who I know is working the sale. And they priced it where it's right. And he's got 3 offers on his property right now. And the property's been listed for 3 weeks. So it's just the timing of it has changed a little bit. The frenzy is not as hot, but we're still in a very good market where we'll experience capital appreciation, just not at the pace that we did just a few months ago.
Yeah, that's a very, very good example, right? Especially when we talk about luxury homes, a $50,000 or $100,000 reduction in price on a luxury home, more than $1 million anywhere in the country, you would think is a big price drop, but it's not. It's only like 3 to 4% price drop. There's nothing. That's a drop in a bucket, quote, end quote, to me, right? And that could skew the data, the same data that I'm sharing with you here, So sometimes, statistics are, are not accurate, or doesn't tell the whole story. But so the next link I'm gonna click is going in align with what you just said. I mean, we are still at a very historical low inventory as we speak. And although the demand has subsided due to the interest rate rise, demand are still pretty strong. So I'm going to click on month of supply in the Birmingham market, and year to date is the week of supply is 11.8. So all you gotta do is divide 4 weeks, which is equal a month, into 11.8. We're talking not even 3 months supply of inventory. Now, in case people do not understand, a balanced market is anywhere from 4 to 6 months, right? So right now it's still a very strong seller's market at at 2.6 months supply of inventory, according to this trend line. Still demand is higher than supply, and the list prices should increase at least at a single-digit level for the foreseeable future. So so this is still, just because there are more inventory, people think just because of the nationwide, just because there are more inventory, it does not mean we're going to a crash correction or a bubble. It just means that there's not enough demand to accommodate the increase in the inventory. Thinking that housing is really bad. It's not really, because it's anyway. So what are your thoughts around the inventory level here in Birmingham, Alabama, as I just.
Well, I mean, I can just tell you firsthand experience. So we have, as a turnkey, so I'm going to speak in two terms. So I'm going to speak, as a seller of primary residential properties to the owner occupant, and then selling rental properties to investors. So I'll start with the selling rental properties to investors. Our supply that we get, so we get a lot of our inventory from wholesalers, for sale by owners, things like that, where we buy houses, we own the franchise in Birmingham. So we source a lot of opportunities through those channels. We've seen an uptick in availability of inventory, not because people aren't buying, but what we have found is that companies that are like, they call themselves turnkey, or they're just house flippers, they don't have the capital to continue to buy at, let's say, higher acquisition costs, because they're usually using private money or hard money to run their operation. And so they start falling out. Like I've seen this happen before. They start falling out, do less, or pivot and go do something different. So my acquisitions team is saying that, we're getting a lot more deals sent our way because we've got a very, strong line of credit. We've just got it increased by the bank. I just got the notice this morning. The bank that we use to fund our operation has increased our line another $4 million. So we're sitting at 18 million as a line of credit. So that helps us, continue to buy, whereas some other house flippers, if you will, can't afford to do it any longer. They're just too small. The operation's too small. Their line of credit is too small, or they're using hard money and it's really expensive. Those rates went up, and so it put them out of the game. So that's one aspect that investors need to be aware of, is that yes, there's inventory, and we're getting it. We have much more to look at now than we did just a few months ago, because some people are getting out of the game. Now, on the primary residence side, because we do build new homes, we do sell directly to the owner occupant. Those sales are strong for us. So because we're priced right, I'm not selling a 350,000 new construction where it's only 1,000 square feet. I've actually seen this in the marketplace. That's not what we're doing. We can still sell we call it between 1,300 and 1,800 square foot brand new construction home for under $250,000. And we are still selling them. So we still see a still strong, healthy demand for the products we sell on both sides, owner occupant and rental properties.
Well, I totally agree with you. You guys, as a top-notch leading turnkey provider in your market, has been doing a great job for real estate investors and owner occupant at the same time. So as we recap this Redfin weekly housing data, all this data clearly tells me that the Birmingham market is very stable, is on an uptick. So all the metrics, all the data seems to be very, very positive moving forward. There is population growth, job growth, migration growth into Birmingham, Alabama from other part of the country. And finally, your price point for investors are so attractive. I mean, it's like the resale homes you're selling is only like between 120 to 160, 180K. You can pay for $1,300, $1,400, $1,500, and you can cash flow with 25%, just a little bit at 6% interest rate for investors. And you have new constructions in the suburbs of Birmingham. Also, it's only like 230K to 250K single family home new construction. Your builders building for investors, which is amazing, because you're not going to find this kind of price point with the cash flow, with a turnkey approach, with a property management, with any other turnkey provider that I know out there in the country. Having these returns and this cap rate and this such a great out of state remote investing, easy to do, one-stop shop. So that's my recap on this as I support the data with the Redfin, with my opinion. So what are your recap with respect to what Redfin data is showing, what's actually going on in the market in Birmingham, and what's your takeaway quickly as we conclude this presentation on Birmingham?
Yeah, so the supply, even though I would say recap is, even though we're starting to see more houses come onto the market, it is not enough to meet the demand. So we're still in an equity growth play with real estate. The job growth and the population growth is strong in the Sun Belt areas, so that's where we keep our focus. And you know, the one thing that Spartan we're doing, we're recognizing that we want to help investors who may need that just little extra push, right? Because even though interest rates are still low, historically low, you know, they're not as low as they were 6 months ago. So that can kind of make people sit on the sideline and wait. And I was having this discussion with someone else in the industry about why wait. Because if you think that interest rates are going to continue to rise, it doesn't make sense to wait, right? Because now you're just paying more for a house that costs more. And maybe at some point the house is going to soften, but not enough, not until most predictions are until 2026, 27, until we get back to that equilibrium of 6 months supply or more. Some markets will meet that faster than others, but for the most part, you're just kind of looking at the overall average. And so what we were talking about is like, why wait? You shouldn't wait just because if you think interest rates are going to rise, you're just going to pay more for the borrowing cost. If you think the home prices are going to drop at some point, softening, yes, but depreciating, no, decelerating, yes, but at a pace that is still positive on the appreciation piece for us as investors. And then, you know, we just thought, you know, if investors need an incentive, to, jump in and buy real estate, and at our price points, 250 and below for new construction. I mean, come on, 250,000 for brand new construction. We have a lender that is offering 5.25% with 3 points, but Spartan is buying down 2 points, right? So if you've got investors that are listening to this and you're going, oh, that actually sounds more attractive because the cash flow looks better at 5.25 than at 6%. And if you've got, and this is for homes over 200,000, we're buying the points down on. So for anyone that's kind of thinking about that, there's a good incentive, and you can probably find other turnkey companies that are going to give you some sort of incentive to you know, take action, because we want to just help reduce the borrowing costs. You still get good cash flow. You get an appreciating asset that reduces your tax liability, and is a great hedge against inflation because you can escalate the rents over the time of ownership, which most people own 5 to 7 years before they do something with the property. So get out of cash, put it in a hard asset in a great market that's growing.
Absolutely, Maureen. You know, your final 1 minute of a very coordinated comment. It's just such a value add proposition. Your new builds, you know, 230K, you know, the builder, your in-house builder, gonna buy down the rates. So at a little bit over 5%, at 25% down payment, with a lower mortgage interest rate. I mean, the investor is going to cash flow quite nicely. So very desirable, very attractive incentive you're providing for any investor, any savvy investors that just heard what you just said. There's absolutely no reason to stay in the sideline. There's absolutely no reason to take action, to take advantages of this lower rate from the builder, which is amazing. So it's amazing. I can go on and on, but I'm all in with your market, with your turnkey provider. So I'm encouraging all the serious out-of-state investors to look into your market. It's just so amazing.